Today, is it up or is it down? Hello again, it's Martin North from Digital Finance Analytics, World Knowledge's Post, covering finance and property news with a distinctively Australian and New Zealand flavour. Today I'm joined again by Joe Wilkes. Hello, Joe.
Good morning, sir. How are you?
I'm pretty good. How about yourself?
Very well, very well.
Now, you've got some interesting stories to tell me with regard to the Reserve Bank of New Zealand.
Yeah, well, I thought an appropriate day today. We've had a statement published yesterday by the Reserve Bank of New Zealand, well, we've had a rosy economy for many, many moons. We've had a very, very low cash rate, 1.75%, the governor, Mr. Orr, has got a bit dovish in his speech yesterday. Last few statements have been very much along the lines of the next move in the cash rate could be up or down. The tone of yesterday's speech was very much towards the risks that are building and the possibility for a need to look at a reduction in the official cash rate. So lots of what we were expecting, unnatural measures. There's a bit of clamouring for relaxation of low deposit lending because despite the adjustments made in January, it hasn't had any marked impact or uptake from the wider market, and credit growth is flatlining. Just over $4 billion worth of new mortgages written last year. And you and I know that everything survives off the back of that credit impulse.
Yeah, the old credit impulse is definitely it. But that was interesting because the statement was certainly changed, and basically they kept the cash rate on hold, but said most likely the next rate move will be down. And of course that mirrors precisely what's happening now with Europe, the UK, the Fed, and Australia as well. So everybody's now panicking because essentially the growth momentum is easing around the world.
Yeah.
And the only answer, cut rates, try and get more credit.
Absolutely, and it's been interesting for me. I've done a little bit of sort of background research into this whole monetary policy phenomena, and it's all our fault, Martin.
I had to blame somebody, so it's New Zealand's fault. Okay,
yeah, well, we came up with the whole idea apparently. Back in the late 70s and 80s, New Zealand suffered with very, very high inflation rates, and it was New Zealand's Reserve Bank economists that came up with the plan to try and target 2%, or originally a 0 to 2% inflation target. Their economists were then invited all over the world to talk about how wonderful this was. So by the mid-90s, even Mr. Greenspan sat down and said, well, yep, sod it, we'll put a 2% target on inflation, and we'll look at consumer price index as being the measure of where we target our band. In New Zealand, I suppose that their guidance was really sort of quite frameworked. Was consumer price inflation was the key. They'd had this massive inflation during the 80s, 70s and 80s. It basically set up with four objectives. One was operational independence, so separate to government, and the idea that they were, they're never truly independent because they return a dividend to the Crown, or the Crown accounts. But the idea was that policy would be independent. Transparency was the other thing. I think New Zealand's very good at that. With our Reserve Bank dashboard, was still very transparent. But the single objective was price stability, and price stability on CPI, which I don't know. I look at various measures of inflation, RPI, CPI. RPI I like to refer to as rich person's inflation, and CPI is it's actually PPI, poor person's inflation, because the basket of goods I don't think manifests itself into a true reflection of the economy, and with the neglect of asset price increases and credit increases within the framework. You're always going to undershoot that, and we've seen it in New Zealand. We've had persistently low inflation throughout the last decade, but where asset prices have gone up exponentially, exactly what you've seen in Australia. The fourth, and quite an unusual one from a New Zealand perspective, was that their original framework was that there'd be a single decision maker, and that decision-making process lay solely at the hands of the Reserve Bank governor, and has done, albeit they are looking at changing it now. And we'll have, I think, either yesterday or today, we'll have an announcement of other policy members who will form part of this from both within the Reserve Bank and external advisors. So it's been interesting, and I think that we're the dovish tone that we saw yesterday is it's an immediate reaction to the drop off in volumes of house sales that we've seen in February, and we're continuing to see in March. So nationally, volumes were down 9.5%. During the February month. In Auckland, they were down 19.1%, so quite big drop-offs in actual sort of transactions year on year, and that's hampering the credit growth. The way out is to lower the cash rate. The banks are all already lowering their cash rates, their 2-year offerings. So before Christmas, it was a few that slipped below 4%. Now we've got 8 of the 11 lending institutions are below 4%, but not on 1-year money, on 2-year money now. So there's this I suppose very, very dovish response from the RBNZ, and no doubt he's getting a little bit of he'd probably get a few words in his ear.
Yeah, so there's two perspectives there. I think the first is on CPI. We know that the official CPI numbers are much lower than the real lived experience of most people that we speak with and survey, right? Yep. And that's partly because, of course, the costs of owning home are actually substantially different from the imputed value that's in the CPI numbers, which is a sort of a quasi-rental thing, right, which doesn't really give you much help. But there's also, I think, another factor, and that is that a lot of the weightings in the baskets that are used to calculate the CPI are actually quite irrelevant for most households. Right?
We had it over here, the heavy weighting on electrical goods, things like flat screen televisions, which, I mean, I've bought one flat screen television in the last 5 years, so it's not a regular purchase event, but it's included in the CPI numbers. And CPI, it's quite interesting when you look. I looked at a speech that was done by a former economist at the Reserve Bank of New Zealand, and it was done back in April of 2018. And we're a nation which we've got a very proud history. Independence suffered a lot when the UK and Great Britain ditched us for the EU in the 70s, and we've managed our way out of what was an incredibly challenging situation, inflation running rampant, a lot of our agricultural market having to find other sources to go to. And that pride, I think, sometimes extends to within these institutions. Part of this speech done by a former economist of the Reserve Bank he actually made the speech in Sydney. And I'm just going to read a little quote from it. The evolution of the inflation targeting framework in New Zealand can be characterised as one of increasing flexibility, consistent with academic literature and with developments in other advanced economies. As our tree grows taller and its roots deeper, as we gained credibility by actually meeting our target and enabled inflation expectations to be met under control, we could be more confident that our tree could bend in the wind without being turned over. That type of feeling from within the institution shows that we've had, New Zealand has been running this now for 30 years, but that type of thinking within the institution, that says that is our primary focus. They've had, since the recent change of government 18 months ago, we've now got a double focus of looking at unemployment as well. So the core price measure and inflation side of that, they have got this added thing, and they've probably been given a little bit more responsibility for macro-prudential regulation and implementing LVRs. Now, I met with an ex-economist at the Reserve Bank of New Zealand recently, and it was very plain that the CPI was the measure. Credit wasn't necessarily ignored completely, but the idea of credit as being there is the trade-off. You'll have your debtor, your creditor, and the influence on core asset prices. I think that the mindset about the stability of these of asset prices, and stability means they don't go down. So that is ingrained in the mindsets of those that are formalising policy. We've got a system which has been adopted around the world, which is going to continually try and increase the money supply.
Well, then of course the central banker's view is that credit is fine because effectively for every piece of credit that's created, you have an asset and a liability that cancel each other out. So essentially, we don't need to look at that, right?
Yeah.
When, of course, we know that, in fact, unfortunately, we've got the situation where credit creation means that banks can create ever more credit, providing there are mugs who are willing to borrow. And we go on with that until we get to the point where people are unable to service those loans or are unable to get those loans. And at that point, credit impulse changes. At that point, we then find economic momentum eases. And that's precisely where we are at the moment. And the only recipe that we have from a central banker's perspective is, let's cut the rates a bit more then. Which, of course, is now why we're getting discussions into zero interest rates and below. And it's interesting that overnight the ECB came out... Yes, the European Central Bank came out with some thoughts about how to protect banks in a zero interest rate or below environment. So it's signaling again, they are signaling again that they are going to take rates lower, right? Simply to keep this money machine alive. And of course, what I keep saying is, and I'm sure it's the same over in New Zealand, what about those people who are savers? What are those about those people who have, religiously saved to protect their futures? They're just seeing the returns on those savings going down and down and down and down because deposit rates are already being cut. And means that people have one or two choices. Either you just chew your capital, right, particularly as rates go into negative, or you're forced to take higher risks in terms of trying to protect some of the assets that you've got. And that's why there's interest in things like gold and Bitcoin and other things, and of course property previously, but not now. We've just completely lost the plot, in my view, in terms of actually what's good for the broader economy and for households. Yeah, interesting times, Joe.
Appreciate it, Martin.
So there you have it. Very interesting perspective with regard to central banks and how they think and how perhaps myopic they are. I'm Martin North from Digital Finance Analytics. Many thanks for watching. We'll talk to you next time.